Welcome to this video. Every trade taken while trading comes with risk. That's why we don't tend to avoid the risk, but we calculate the risk, and that is what we call taking calculated risk. In this YouTube video, I'm going to be introducing risk management. I'll teach you how to set and protect your trade. I'll teach you how to calculate your risk before you enter, just with a click of a button on your phone. If you stick longer to the end of this YouTube video, I'm going to be showing you my 3 personal risk management trading strategy I use to make profit from trading. If that sounds interesting, I would want you to please give this video a quick thumbs up below and smash that subscribe button beside it and turn on your post notification so that anytime I post awesome videos like this, you'll be the first it gets to. And moreover, you'll be telling YouTube that you like this kind of video, and in that way it refers videos like this to you that will help you grow as a trader. So guys, every trade a trader takes comes with 2 outcomes. Either it is a win or a loss. Every signal I'm going to be dropping to you on my Telegram community is not going to be a winner. There will be losses, and that doesn't make me a failure. What we do is what? Manage losses. Just like when you toast a coin, you have what? Either what? 2 outcomes, a head or a tail. A head is win in our scenario, and a tail is loss in our scenario. And as a coin toaster, you now realize that there's a way you put your fingers and a way you would toast it, which we call trading strategy. That if you do it, that you out of 10 times you throw it up, that you must get head 7 times. That is what having an edge in the market. Can you see now the losses are actually there? So look at what a beginner trader does whenever I call out trade. We tend to do whenever I call out trade. He will say that, wow, Victor Snow have posted this trade. That this thing is a life-changing something. His hands will be shaking. He will rush. He will risk 50% to 100% of his trading capital. That is, he killed his life, or he divided his life into 2 now. That is, if I post another word signal that will probably he takes that signal and it is a loss. Probably when I post another signal that will be a winner, he will not have any life to take it. He will not have any money to take that trade. And that is what we will call managing risk. So guys, the first method of managing risk is what? Putting a stop loss order. You are telling market that if you are wrong, it means that this setup is wrong, that I'm not right. Take me out here with small losses. That is cutting your losses short. Let's take, for example, you want to buy with that long buying so I talked about in my previous video, and if you haven't seen it, click here to see it. That you entered what with from a definite long level, like you are from a 2, and you're targeting that market Eurusd pair moves towards 4. And what market has 2 outcomes, a win or a loss. Now from that 2, now market will come down to, might go to 3 or come back to 1. Then if it's going against you, you should have something to protect you now. That is, you put your order, stop loss order at 0. Now if market comes down to 0, you don't want to be in this trade. Protect my capital from you. Now let's see how we'll be able to set a stop loss order using my signal from my Telegram channel. So you just have to go to your Telegram and you open, try to get the interest of signals that I sent. You open your MetaTrader 4, click on Euro, USD, click on your order. So you go back to your Telegram to copy the orders, and you put in your stop loss order by the left. Stop loss is at the left side of it. Then the right side will be our take profit level, and the order is open. So the second way to apply risk is what? Position sizing. Knowing the quantity of something you're going to be buying, because you can actually buy something that is way heavier than you, and the thing will break your head. So guys, position sizing is when you go out there to buy something. You want to go and buy cement. You know the amount of quantity of cement that you want to buy. You don't want to buy something that is way ahead of your money. If not, you would incur more risk to your self. So guys, this quantity of goods here now in forex trading is divided into 3 only, which we have number 1, standard lot size, which is 100,000 units of the base currency, which is denoted with number 1. The second one we have is what? The mini lot size, which is 10,000 units of the base currency, which is denoted with what? 0.1 lot. And the third and the final one we have is micro lot size, which is 1000 units of the base currency, which is denoted with 0.01 lots. So guys, one standard lot size means what? Price moves $10 per pip. That is, you make or lose $10 per pip movement. One mini lot size is price moves what? $1 per pip. The third one micro lot size means price moves 10 cents per pip movement. So guys, the question here is, what is actually pip? And before we do that, I want you to please give this video a quick like and a subscribe, and that will help us grow this YouTube channel. And besides, we're already growing. Just a few days ago, just started in a short amount of time, and I have 18 subscribers. I want to thank you guys that are watching this with me. So I want you, new viewer, to smash that subscribe button to be a member of this great community. Have you done that? Have you done that? Good. So what is PIP? So the word PIP means point in price. PIP is what? The measure of how price changes between 2 markets, which is what? USD and the United States dollar. So as a currency is moving either up or down, it is moving in pips. We say 20 pips, 30 pips, 40, 100, 2 pip, 1 pip. Just like we use cup to measure gari, we use it to measure rice, just like we use micrometers to measure small distances. So guys, another form of risk management is this thing we call leveraging. Leveraging is taking money from your brokers to amplify the size of your trades. Your brokers now can actually lend you money. You buy your small capital. Like example that I gave, my $7, I bought Solana at the price of $88. Normally you can't buy Solana at the price of $88, but I used $7 in buying. What my broker did was they gave me a leverage. So guys, for you to make a sustainable amount of profit, you need capital. And in this case now, brokers give us this leverage. This leverage can either be good or bad. Let me give you an example. As I bought $7 and bought Solana at the price of $88, it means that I will be making what someone that bought Solana with $88 is making if price goes my way. The downside to it is that I will lose what someone that is losing, that bought it with $88 is losing, rather than something that someone bought with $7 is losing. And when I make something someone bought with $88 is making, rather than what someone I bought with $7 is making. So this leverage is a lot. You can, if you use a high leverage, leverage is in form of lot size, that standard that I talked about. If you lose the one that is more than your account, in seconds you can lose your account immediately. So what traders do is they see this amount of capital, their body go to shiver. They will put and only see the good part, but they don't see what their money they will be making. So guys, the question here is, how can you know the right lot size to use for your particular trade? And to be doing that, we're going to be needing an app, which will be at this YouTube's video description. Look at how you're going to be calculating your lot size. And we click on search words to search FX calculator, then install it, open it, click on position size, and we have Eurusd, and we have the option to choose our currency pair. Choose USD, have the pair option for pair, then account balance. Mine is $5,000. You can actually choose any amount according to the amount you have. Then the risk could be 2%, 1%. Then stop loss is in pips, could be 20 pips, 8 pips, 30. And here you see the results. We have standard. We're going to be using standard to place a trade. Don't take mini or micro. Take the standard, and you see the amount you're going to be risking, which is $50, and you see the amount in pip value and exactly the stop loss. So guys, now that we've gotten the quantity of what we want to buy, let's now take a trade. I'm going to be using my Telegram signal as, for example, copy it, launch MetaTrader 4, click on EURUSD, place new order. Put in your stop losses and your take profit level. Then we have types of order. Market execution is simply if market is at 2, that it should feed you exactly at that 2. Buy limit is if market is at 2, that it should feed you in at 1. Sell limit is if market is at 2, it should feed you in around 4. Buy stop, if market is at 2, it should feed you in at 3. Sell stop, if market is at 2, it should feed you in around 1. And we're going to be using market order for this example. Click on buy to confirm. Now we can see our order right here. You can click scroll to see the order visible in chart. You can see the SPY, the stop loss, and our take profit level. So guys, this video won't be complete if I don't talk about risk to reward ratio. The risk to reward ratio we have is 1:1. Before I explain it, 1:2, 1:3, 1:4. It can go up to 1:10, 1:100. 1:1 risk to reward ratio means if I put $10, let me make $10 if it goes my way, and I'll lose $10 if it goes against me. 1:2 risk to reward ratio means that if I put $10, if market goes my way, I will make $20, and if it goes against me, I'll still lose that $10. 1:3 risk to reward ratio means that if I put $10, if market should go in my favor, I will make $30, and if it should go against me, I will lose that same $10. Can you see that as a trader, you have to you want to make your risk to reward ratio to be high as possible. It means that if you lose for every dollar you lose, if you have 1:5 risk to reward ratio, it means that for every dollar you lose, that you make $5. Do you understand? Tell me whether you understand at the comment section. So guys, we've gotten to the point we all have been waiting for. The 3 risk strategy I use is, first of all, my number one. I use it in trading my personal account. Is the number one, I risked 1% per trade to make 1:1 trade RR risk to reward ratio. It means if market goes my way, if I put $10, I'll make $30. If it goes against me, I'll lose $10. Then my second risk strategy that I use is that if I want to flip account, flipping, for those of us new here, is when you can move your $10 into $700 in a day. So if I'm flipping account, just like in that Solana scenario, if I have $500 I want to use for flipping now, I can divide it into 5 times now, or 6 times. I'll divide it into 5 times and I'll open different trading accounts. Your broker has that option. Do you understand? I risk it 100% by each of them. This helps with your trading psychology. Then the third one I use is for my prop firms now, proprietary firms I talked about in the other video. Is when if I'm going for challenge, if I'm risking 1%, if I win the first trade, I'll increase my risk to 2%. But if I lose the first trade, I will go back to 0.5%. If I take the first trade and I win it, I move to 2%. If I take another trade and lose it, I'll go back to 1%. If I take another one and I lose it, I'll go back to 0.5%. So if the time that I took the trade I won and I'm at 2%, and I took another trade I won, I'll move to 4% or 2.5%. So you have to backtest this to know which is good for you. So guys, you've come to the end of this YouTube video. I want to thank you for making it up to this point. I want you to please give this video a quick like and a subscribe to be a member of this great community. So guys, in trading you need only 3 things to be profitable. What's 3 things? First thing is your attacking mechanism. Second one is your defensive mechanism to protect yourself. The third one is something to keep your inner self alright. With our quality mental analysis. So the first one is strategy, second one is risk management, and the third one is trading psychology. If you know how to trade, if you don't execute it the right way, you will definitely not get the same process from what that strategy is supposed to give you. So guys, I'm going to be introducing a complete idiot guide to trading psychology. I will see you in that YouTube video.